Love this podcast? Support it and sponsor today. Simply head to ozcastnetwork.com for details.
The information contained within this podcast does not consider your personal circumstances and is of a general nature only. You should not act on it without first obtaining professional financial advice specific to your circumstances.
Paul Atherton is an ex-Wall Street advisor on a mission to help young people win back their financial power, wealth and security. He does this by helping them understand the hidden world of finance, risk and investments, helps them figure out how it impacts them, and to seize the opportunities to make it work to their advantage. This is Paul Street Journal. Thanks for joining me, Paul. I just had a quick question about indexes. I don't really know what they are. Could you explain?
Well, that's a great question, Tim. And it's often asked, what is a stock market index? Well, an index is a grouping of individual stocks, and the stocks themselves are market traded, meaning that you buy and sell these stocks on the open market exchange, such as the New York Stock Exchange or the Australian Stock Exchange. The stocks within the index are considered to be representative of something larger. So, an index, in other words, represents something, and that something is usually, not always, but usually the economy of the country within which the index resides. So let's use a couple of examples. So the classic index we might all think about is the Dow Jones Industrial Average. The Dow, which we often hear quoted every evening on the news, was created by then Wall Street Journal editor Charles Dow in May of 1896. So it's been around for a while. The Dow contains 30 stocks, which, as I mentioned earlier, represent or are meant to represent the US economy at large. Now, originally, the Dow, there was only 12 stocks or 12 companies representing the US economy back in 1896. In 1916, this was expanded. The Dow was updated to include 20 stocks, and by 1928, it was expanded to include 30 stocks, which it still does to this day. Again, the Dow is an index, and it is meant to represent the US economy. And the Dow has a different way of calculating its value. Essentially, it's an average of the stock price of the 30 companies that are within the index. Now, this is highly unusual. Most indexes are valued in a more complicated fashion, such as, let's use the S&P 500, and that is priced off market capitalization. And this is far more stable and far more meaningful. And it's for this reason that professional money managers watch the S&P 500 and compare their performance to the S&P 500. Whereas the Dow Jones Industrial Index is really something just to be watched. Stocks change in the Dow. Stocks enter and exit the Dow, but it's always 30 stocks, and there have been 54 changes of stocks in the history of the Dow Jones. The latest one was in March of 2015 when the Dow placed Apple into its index and dropped AT&T out. So stocks can come in and out of the index, but it's always only 30 stocks. The United States also has, as I mentioned, the S&P 500, which you may have guessed is 500 stocks representing the US economy. For Australia, we have the ASX 200. In the UK, there's the FTSE 100. And there are many more indexes around, and for each different country has indexes, and some countries such as the United States and Australia and the big industrial countries have many. So in summary, indexes are representations of a market, and generally it is a representation of an economy or part of the economy. So I hope that helps, Tim. Thank you.
Paul Street Journal.
Love this podcast? Support it and sponsor today. Simply head to ozcastnetwork.com for details.